know. So I called Dan up yesterday, so we threw this together yesterday, and I was like, hey, we had a lunch scheduled for today anyway.
We should be eating burgers right now.
Yeah, I know we should be eating a nasty burger from Lake and Irving right now. But so I was like, well, hey, man, would you want to do a Zoom call instead? Because I think this is an opportunity for us to get some information out there for people that might want it and just talk about what's going on in the market and, you know, how you might be able to navigate, you know, investing here with coronavirus going on. So, so Dan was down to do this call, so this is great. And then I had, you know, so how I met Dan is through a thing called Business Networking International, which is a business networking group, and he was in there as a fitness and you know, nutrition specialist, and I'm in there for restoration. And we had a conversation one day, and he said he dabbled in real estate. I was kind of interested in that, and you know, it just kind of blossomed. And a couple months later, I was doing I got in on one of his deals, and over the time, we've developed a friendship, and I've got to know him and kind of, you know, sit down. I'd probably consider him a mentor in real estate and investing, and you know, Dan knows a lot of stuff about you know, investing and finance, and I thought this would be a good opportunity for some people that are sitting around doing nothing right now, an opportunity to get some information out, just kind of share a conversation with us. Unfortunately, I wish we had some more people that wanted to learn, but you know, that's probably why most of America doesn't have a savings account, right? Because they don't want to learn, they don't want to hear the truth. So that's how I met Dan. So, you know, I'm going to ask Dan a couple questions. This is kind of what his background is, and then we'll just kind of, I'll ask him some questions about the market and investing and things of that nature. We'll just go from there. So, so Dan, tell us a little bit about, you know, where you're from, you know, where'd you grow up at?
Yeah, I grew up right here, actually. So I live in Minneapolis now, grew up in St. Louis Park. Went to college at St. Thomas, studied finance there. And then I've always lived here. My wife's the one that's done a lot of the traveling earlier in life. So she's got me beat in that department. But yeah, I'm from right here.
All right, so you went to school for finance. So is that how you got into finance and like finances, and, you know, just kind of how did that journey start for you? Because like people like me, you know, numbers, we don't get along, you know, so how are you a numbers guy? How did you get into it?
Yeah, well, I've always been obsessed with, it sounds weird to say, but I've been obsessed with money ever since I was a little kid. Like when I was like, I used to go to coin shops when I was like 5 and 6 years old just to buy like paper currency from other countries because that was really cool looking, and I would like frame it and put it on my walls. So where like most kids would have posters of like sports and cars and stuff, I just had like pictures of money. And that sounds like really kind of vain and greedy to talk about, but I just thought it was fascinating, and I was just kind of obsessed with trying to like accumulate it. And so like I get my allowance and collect it into like an empty checkbox, and I wanted to see the stack grow. So I've always kind of been obsessed with it to some degree, probably just because I grew up in a really I don't want to say like low income house, but we were on like the bottom end of middle class. Like there was no like spare money for anything. So you know, they say you always want what you don't have. So that's probably where that kind of obsession came from when I was really young. And then when I was like somewhere between like 10 and 13, somewhere in there, I saw the movie Wall Street, and then I saw the movie Boiler Room, and I saw a lot of like kind of glamorized depictions of investment bankers and traders. And I was like, oh, that looks cool. I want to do that. And I was kind of obsessed with the idea of being like an investment banker or a trader of some kind all through high school, and then ended up going to school for finance. But since I graduated in 2011, there weren't a ton of jobs in that space after the 2008 crash. So I ended up in corporate finance, which was, you know, still a great learning experience, ended up being pretty applicable to the real estate world. But yeah, it was during that 5-year stint of working in the corporate world that I got obsessed with the real estate concept, and then transitioned into that back in 2018.
Okay, and so how long were you working in corporate finance for then?
5 years, I think.
5 years, and then so you got out of that, and is that when you got it into the real estate game, or you know?
Yeah, I started getting really deep into the research the last year of my corporate job, and I started shopping for properties the last I think 4 or 5 months. And then I left the same month that I closed on my first property.
Okay. And what made you, having worked in corporate finance and kind of, knowing the stock market and things of that nature, what made you switch gears and want to get into the real estate side of things?
Well, I got bit by the entrepreneurial bug when I started that nutrition consulting business, and that was about 4 years before I got into the real estate game. So initially, when I got into the corporate world, I thought I wanted like that safe and secure salary. Like that was really attractive to me because I was really risk averse. I had some student loans because St. Thomas is an expensive school. And, there were opportunities in the finance world that were a little bit more heavily weighted towards commission or entirely commission that could have been very lucrative, but I wanted to have that strong salary. So that initially drew me to the corporate world. And then after starting my own side hustle, if you want to call it that, I got really obsessed with the concept of running your own business, because your income and how well you do is directly correlated to how hard you work. And in the corporate finance world, if you work your butt off, you can get a little raise, you might get a promotion, but there's not a direct correlation, right? So I like the idea of how much control you had over how big you got or where you went of running your own business. And so that's where the mindset kind of switched from being like a lot of people and seeing like that salary as being safe to all of a sudden seeing that as being like a limiting factor. Where if I take my work ethic and apply it over here, I can actually do exponentially better, even though there's, at first glance, it seems like there's more risk to it. But in reality, I started to kind of do the math on my consulting business. I was like, okay, if I, for that business to fail, I've basically got to get fired by, at the time I had like 40 some clients. I need like 40 some people to fire me, right? In my corporate job, I need one guy to fire me and my entire income's gone. So I kind of saw that as more of a diverse stream of income because I've got 40 clients that are paying me to provide a service, and it actually ended up being safer when I looked at it from that perspective than having one job that provides my entire income.
Okay. And then, so I know recently you had partnered up with a gentleman, and you guys have started Invictus Capital. Maybe you can tell us a little bit about that, and what's that all about?
Yeah, so once I got into the real estate thing in 2018, I was operating under the brand of DGK Acquisitions, which is just my initials, super creative. But after getting into the real estate game, I realized the power of networking and partnering with people, and ended up meeting Anthony at a networking event, and he and I initially didn't plan on being partners or anything like that. We just kind of met each other, decided to meet up again for coffee afterwards because we thought that we both thought the other person was interesting. We wanted to kind of continue the conversation. And then after meeting with him a few times, we realized that a lot of his strengths were my weaknesses and vice versa. And so we're like, okay, there's actually some synergies here with my experience and your experience, and we both have pretty comparable goals. So we decided to kind of join forces around, I think, December of last year. And then for branding purposes, we just, switched. Like DGK Acquisition still exists. It's just basically my property management company right now. And then Invictus Capital is basically doing the same thing. We're going and we're acquiring multifamily apartment buildings, and it's just kind of the brand that represents that. So same business model, just adding Anthony to the equation and having a brand that isn't necessarily attached to my name.
Gotcha. All right. So let's just move on here and just talk a little bit about, what's going on in today's market, with, I'm not sure how many people on the call have 401ks and things of that nature. But I'm sure it'd be good to kind of talk about that. So, what some of us, probably being affected by that, what's going on in the stock market right now? Why is this kind of stuff happening? And what are there going to be the repercussions to our 401ks and our IRAs and things of that nature?
Yeah, 1 second here. I'm going to close an application that's slowing things down for me. So basically, the value of a stock is based on the projected future earnings. And what we've got happening right now is slowly but surely the economy is getting shut down, right? So all the values of every stock coming into this year were based on the assumption that business would be operating every day this year, right? No one would have thought that there would be a 2 to 4, maybe 6 or 8 week period where businesses aren't operating and they're not generating revenue. So all of those projections for future earnings are getting cut down, right? So that means the theoretical value of most stocks, not Campbell's Soup and not Zoom, because these companies are doing really well, but pretty much every other company out there is getting hurt. And so, in a really kind of layman's term, I think we've all heard EPS, earnings per share. Stocks are basically valued based on future earnings, right? And they're trading based on a multiple of those earnings. So I'm just going to make up some numbers here. Let's say Apple usually trades at 10 times earnings. Well, the earnings number just shrunk down. So 10 times earnings is now a smaller number. So the value of the stock is coming down. So basically that's what's happening is instead of having a 12-month year of operating activities for most companies, we're going to have like an 11-month year or a 10-month year. So less earnings means the stock is worth less, which means the price goes down. Combine that with the fact that everyone's scared. No one really knows exactly how many cases there are. No one knows how bad it's going to get. You get emotional selling from people who are freaking out. And then to make matters worse, there's so much algorithmic trading activity now where there's basically just quant funds that are running algorithms that get triggered by certain price points in the market. So there's just this cascading effect of algorithms just kind of compounding everything. The amount of volume that we're seeing on a daily basis right now is insane. So it's partly due to fear, it's partly due to algorithms, and then mostly it's just due to the whole unknown. We don't know if this is a 2-week thing, a 4-week thing, or an 8-week thing. So everyone's just like, sell it all, go to cash, and that's why we're down like 33% or whatever it is now.
What do if somebody, has an IRA or, an 401k or some kind of, savings bonds and things like that, like what would your suggestion be for them right now? What should they be doing with that?
Yeah, and it's tough because that's what's been frustrating me when I have CNBC on pretty much all day now because I'm kind of day trading futures, just kind of taking advantage of the volatility to kind of trade in and out of things and I pretty much just do the futures contracts on the S&P 500. So I'm in and out in like a minute or two. So it's not investing whatsoever. It's just something I do for engagement. But so I have CNBC on all the time, and I hear these people coming on, whether they run a fund or whether they're some kind of advisor at a firm, and they're trying to speak to the masses and say, here's what you need to do. And they're trying to talk to everybody at once. And it's not that simple, right? It's kind of like when we work together on the nutrition thing, like everyone needs their own solution based on their individual situation. And there's no one size fits all answer for what people ought to be doing right now. It all kind of comes down to what people's time horizon is, the money that they have invested or don't have invested. Do they need it in a couple of years? Are they 55, 60 years old and they're going to be retiring hopefully in the next 10 years? Are they 22 years old coming out of college and they just got a $100,000 check from their grandpa? Are they somewhere in the middle? What's their job security look like? What are their goals financially? What are they trying to get to at the end of the day? There's so many different people in so many different situations. There's no one size fits all answer. So yeah. I hope that doesn't sound like a cop-out, but I just don't want to be one of the talking heads that goes on TV and says, here's what everyone needs to do. Because I was watching the other day, I can't remember what day it was, I think it was Wednesday. Bill Ackman came on, and he's a notoriously short guy. He runs a fund, and he shorted Herbalife forever. And
I know exactly what you're talking about. Yep.
He came on freaking out, telling telling that the Hilton's going to zero, everything's going to zero. The whole world needs to shut down for a month, and if it doesn't happen, it's all going to zero. At the same time, I just bought some Hilton shares. So basically, he came on and just freaked everybody out and said the world is collapsing, everyone needs to get out. And immediately after him, another hedge fund manager came on. I can't remember the guy's name. I'd never heard of him before. It was Eric something. And this guy was saying the exact opposite. He's like, oh, this is great. Everyone needs to refinance their house. They need to pull out equity, and they need to put it right into the market. It's like what the hell?
Right. Because it's like some people are saying it's an opportunity to get in because everything's low, right? So I was, that's basically all I have on right now is CNBC because you get the least amount of political shit, and you can still kind of get some of the coronavirus stuff mixed in. But also, what's most important, if you are trying to get into investing, or if you are, I'm looking at it to see how much is it going to cost, because what it's going to do to investors, right? So on there, they had a guy saying that, hey, you know, the airlines would be a great investment right now, because they're bleeding money, and there's no way that the government's not going to bail them out. So if you throw a little cash at the airlines right now and they get their bailout package, that stock's going to shoot up, and that could be a way to make some money. So, but then will they ever fully recover? And if they do, how much? You know, so it's all kind of risky right now, right?
Yeah, and then if you look back at some of the strings that were attached to the financial crash of 2008 bailout, like some companies where the government was the lender in that situation, that bailed them out, the debt converted, right? And so the actual equity owners in some of the companies that got bailed out back in the last crash actually got wiped out. Like the company was, the equity went to basically zero in some situations. So if there's some sort of situation like that, like, you know, equity is you know, below debt, you know, on the caps side. Well, actually, it's technically above debt, but debt gets priority basically. So if somebody gets bailed out and the government's, you know, providing the debt in that situation, it is possible for the equity to go to zero and the debt to take priority in that sense. So it's, you know, being an equity owner in a share of stock it's the most risky spot to be, right? Regardless of what happens. Like a company could file for bankruptcy, shares could go to zero, and the company actually still exists once they get to bankruptcy, but the equity's gone, right? Because the debt has to get paid off. So it's not quite that simple either. So I wouldn't try to catch a falling knife and try to buy things that are you know, theoretically not going to fail, because even if, you know, something happens and they don't fail, they come through, there might be other nuances attached to how they got through that. So definitely not that simple. I would say that, you know, everyone needs to start by asking themselves, what is their goal with investing? Are they like me, where they're just day trading and they're using money that they could lose and they'd be just fine, and they're just trying to capitalize on the volatility that we're seeing? Are they somebody who's got a 401k or an IRA where they're not going to touch it for 30 years? All right, that person might be able to take on a little bit more risk than someone who's, you know, got like a 5-year timeline, right? If you need your money back in less than 5 years, I would be really careful about what you're jumping into right now, because there's a lot of false bounces. If you go back to 2008, during that time frame, before the market actually bottomed, there were several, you know, 10% plus days in the S&P. And a lot of people get tricked into those. They see those and they're like, this is it. Things are coming back. And it's like, oh, nope, there's still more coming. So I think most people, you know, kind of looking at this call, I'm trying to guess the age range. They've got, maybe you have more insight on here as to how old.
We're probably, most people are probably between, you know, 35 and 45 on this call.
Okay.
You know, and I'm not sure how many people are invested. I would say that there's, just based on the personal relationships, I'd probably say, you know, probably a couple people that are looking to start investing in probably real estate, and maybe some people that are, and we'll open it up to questions, so we'll find out more.
Yeah, that'd probably be the biggest value out there, is to actually answer some questions directly.
So we'll get that shortly here. So let me ask you this then: if you are somebody, you know, that, let's say you do have a little 401k, and you know, let's say you've been investing in it, you know, $6,000 every year, the new cap, or the new or 5,000, whatever, and you got a little money saved up in there, and you're logging in and you're seeing that you're losing money. Should you pull that out, get into some bonds, and again, or are you in the camp that says, if you don't need it anytime soon, leave it in there, it'll be fine? Do you change it from, you know, higher risk to low risk? Like, what in that aspect, what would you do?
Well, to answer your bond question, right now you're not getting paid for the risk you're taking in the bond market. In the bond market, I don't know if I want to open up that can of worms, but that's a whole mess right now. Like, the debt market is completely screwed up. And so right now yields are ridiculously low, and you're not getting paid for the risk. So I don't think people need to be going into bonds right now. And I could pretty much make that blanket statement for just about everybody. I would say that if you have been accumulating money in a 401k or an IRA or some kind of account like that, and you've already lost some, it's tough to provide a blanket statement, but I can talk about myself personally. I prefer these days to invest in things that I have control over, like real estate. And you can do that in a retirement account as well. A lot of people don't know that. You can take your account that you have with Schwab or Ameritrade or Vanguard, and you can transfer it to a self-directed IRA custodian. My investors use Advanta IRA. They're the only company I've used other than UDirect, and UDirect was absolutely awful. I apologize if anyone on the call has any relation to UDirect, but the customer service was non-existent. So you can actually invest into real estate through syndications like we do through an IRA. And I put out a video a couple months back where I back tested how the types of assets we invest in performed back in 2008, 2009. And it was surprisingly good given the economic conditions that we were seeing, which is actually kind of similar to what we're seeing right now, where, I've seen estimates coming out now that unemployment could be, I think Goldman Sachs came out, they said like somewhere in the mid-teens unemployment could end up. Yeah. Mnuchin said that his worst case scenario was 20%. So when you see unemployment getting up that high, there's a lot of people that are shifting from owners of houses to renting. So I like real estate personally. I'm a little biased, but it weathers these types of storms very nicely.
Yeah, so let's pivot to that. So let me ask you this then. So 401k, you're basically saying, let's just, if you got that, either hold on to that, or if you're trying to make some money, maybe what you could do is a self-directed IRA into an investment property, whether it's through a syndicated deal, which we can talk about, or if it's, hey, if you're just going to try to buy something direct. Now, just talking about that really quick, if you do that, from my understanding though, that money has to stay in that IRA account. You're not necessarily being able to pull from that, correct? All the profits stay in there, correct? Until you reach your retirement age, correct?
Yeah, so it'll function just like a 401k or whatever account you have now, where it's still its own thing and you don't touch it until you retire. It retains its tax benefits for that reason. So for people who are interested in real estate and want to actually get their hands on the cash flow and be able to touch the profits and use them right away, using an IRA for that isn't really gonna you're still going to make money. It's just going to be in an IRA, right? So which you won't be able to tap into without fees or penalties until later. So, so for people who are interested in real estate but actually want to, live off the cash flow or transition to doing it full time, the IRA or the retirement account probably wouldn't be the best approach for them. The retirement account approach is just an alternative for people who are sick of seeing 33% losses in 2.5 weeks, right? If you've been through 2008 and now you're going through this now, you're probably getting pretty fed up with this type of stuff. So, that's a great alternative for people who say, I want to have my retirement account, but I don't want to be in the stock market and exposed to this kind of volatility. Yeah.
So let's talk about the real estate market and then how that's an alternative, to investing in, stocks and Wall Street. Maybe we could start here. For somebody who wants to get started, let's start with a starting point. For me, I know for me to get started, I had to stop spending money on stupid shit and start saving. So I had to start going out less, stop buying clothes as much, stop drinking and partying and hanging out, right? Because, you figure if let's say you spend $100 a weekend, right? That's $5,200. So that's a down payment on a duplex on a FHA, right?
Fast, man.
Right. So, what outside of saving, how can somebody get started in real estate investing?
Well, I think the most important first step is always education before you do anything. And I think that whether you're investing in the stock market or real estate or anytime you're doing anything with your money, you need to make sure that you do your homework first. So getting educated on the business model is the first step before you start doing anything with actual money. So I try to put out a lot of content that expedites that learning curve. And in addition to that, one of the books I recommend the most is a book by a guy named Ken McElroy called The ABCs of Real Estate Investing. It summarizes the business model very nicely, so that even if you have little and no experience with the business model, you can pick it up and you can read it and you can understand it. And it's not written so dry where it's like a textbook. It's very readable. It's very easy to get into if you don't have much experience. And it just sums up pretty much every aspect of the business in one book, as opposed to other books I've read that really concentrate on certain aspects. It's kind of a one-stop shop and gets you, it gets the learning curve accelerated very nicely for people. So that's a great first book to read. And then from there, as far as like getting the capital together to actually do it after you've done your homework and you understand the business model and decide that it's something that you want to get into. After that, there's a lot of different resources that people use to find the capital. We already touched on the IRA stuff. That's always an option for people. The first a decent amount of the money I got for my first deal was from a life insurance policy. So life insurance policies are structured in a way that you are able to borrow against them while keeping them still functioning. So you're able to kind of use the money two different places at once. So I borrowed against a life insurance policy for a decent chunk of that first deal. And, that's where I got the capital to get the ball rolling. And then that first deal produced enough profits to parlay into the next one. And then it's kind of a self-fueling machine there, at least the way we do it.
When you said you borrowed against it, who did you borrow the money from? A traditional bank? Where would somebody borrow money from?
Well, usually people will borrow it right from the life insurance companies, right? So, and the reason that that's a pretty good option is because that quote unquote loan that you're taking from them is collateralized by the death benefit. So the interest rate you get is very low, relative to other rates out there. And the payback terms are very flexible, right? You can do interest only. You can pay your interest once a year. You don't even have to pay the interest if you don't want to, but then the policy then the interest payments start to come out of the policy and it kind of collapses in on itself. But so you could take out an interest only loan on the cash value of your life insurance policy, and it's up to you when you pay it back. So you can, and while that's happening, the policy is still paying dividends, it's still growing in value, and you still have the death benefit. And then at the same time, you're using your money in this other deal over here. So you're getting you're getting your money working in two places at once, basically. But they do need to be structured correctly. Most life insurance policies that people are going to pitch are going to be really weighted heavily towards the death benefit and not necessarily weighted towards the cash value, which is what you can actually borrow from. And we had this policy. My wife had the policy from her grandfather. He bought all his grandkids' life insurance policies when they were born. So this one was just kind of there. Normally, I'm not the biggest fan of life insurance policies unless you're using it for this kind of purpose and it's really weighted towards cash value. Then they can be pretty useful. But if that's a strategy that you want to use, if you already have the policy, that's great. You can leverage it. If you want to start to build one up, it's going to take at least a few years before it's something substantial that you can start to leverage.
That's what I was going to ask you. So, yeah, how long do you think you have to wait for that policy? And when you say a cash, what did you say? Well, a cash what policy?
Well, the cash value of the policy is what you're able to borrow against. So what did we? If I'm going to start a life insurance policy, what should I be looking at? Term life insurance? What would be a keyword that I'd be looking for? Talk about plan. A really good resource would be a guy named Garrett Gunderson. You can find him all over YouTube, and he's got something called The Wealth Factory, I think is his company. He puts out a ton of content on how to structure policies for this type of thing. And if you structure it really aggressively, and I haven't actually started a policy like this for myself. We've just kind of leveraged the policy that my wife had that her grandfather got for her. But looking at the illustrations that I've had some companies put together for me, if I were to start putting, like 20 or 30 grand or something into a policy per year, basically using it like a savings account, around year 2 or 3 is break even, where the cash value of the policy is equal to the amount of money you actually paid into it. So initially in your first year, you might put in like 20 grand in the policy, but the cash value is only like 80% of that. So, there's this kind of obnoxious period of getting it up and running. So it's not going to be the quick and easy way to get money, but it's